Okay, so I know that a lot of you have been struggling with monetary policy with these administered rates. And again, I just want to, first of all, thank you for sharing that information with me in your weekly reflection because obviously students have been struggling with this and have not been able to or not had the opportunity to express that to me. So I know now that I need to put some more resources into that particular lesson. So I'm throwing this together really quickly for you right now, and I'm going to work on having some better resources going forward. So I'm going to thank you on behalf of my future students. All right. So again, what I saw in the reflections with many of you were struggling with different aspects of monetary policy and the administered rates. So I've got some slides that I just want to go through quickly and kind of talk about some of this. But the first thing I want to talk to you about before we get into that is this idea of there being two different ways to do this. So we think about pre-2008 and post-2008. So basically, before the Great Recession, monetary policy was done a different way. Monetary policy was done primarily using open market operations. And remember, that's the buying and selling of government bonds. And so what the Fed would do was they would buy and sell government bonds to either increase excess reserves in the banking system or decrease excess reserves in the banking system. So if they sold bonds to banks, if the banks were buying them, the banks would pay for them by having those reserves pulled out of their reserve account at the Fed. And so that would decrease the overall amount of reserves in the banking system. If the Fed bought bonds, they would pay for them by simply increasing the bank's reserve account. So that would increase the amount of reserves in the banking system. What does that have to do with anything? Well, again, what the Fed is doing, no matter how they're doing it, whether it's pre-2008 or post-2008, they're influencing the federal funds rate. They do not set the federal funds rate. They influence it. They kind of push it around. So the federal funds rate, again, is the rate that banks charge one another for these overnight loans, these kind of emergency loans. And the supply of loanable funds in that market is the excess reserves in the banking system. So when the Fed was increasing the excess reserves in the banking system by buying bonds, that increased the supply of loanable funds in that federal funds market. And when supply increases and demand is unchanged, the price goes down. The price happened to be the federal funds rate. If instead the Fed was selling bonds, that was pulling reserves out, so that caused the supply of loanable funds in that market to fall, and so that pushed the price up. And again, the price was the federal funds rate. So that's the way they were doing it before the Great Recession. What changed? Well, during the Great Recession, the economy came so close to failing, to just tanking. It was really, the Fed was in crisis mode. And they were just pumping money left and right into the banking system because they were trying to keep banks from failing. Right? They were trying to avoid a repeat of the Great Depression. And it got to a point where there was so much money in the banking system, there were so many reserves in the banking system, that adding more wasn't doing anything, right? We hit that liquidity trap. Sometimes people will describe it as pushing on a string. If you lay a string down on the table and you push on one end, what happens to the other end? Nothing, right? So they realized that from that point on, the way they'd been doing it wouldn't work anymore. So that's kind of what changed. And so now they're using these administered rates, and we anticipate that that's going to be the way that they continue to do it from here on out. So now the only thing they use those open market operations for are ensuring that there remains a lot of reserves in the banking system. Okay, so now that we've got that out of the way. Again, what we're talking about here is the federal funds rate, and that is what banks charge one another for these overnight loans. So what we're looking at here is the process is going to be that the Fed sets the target range for the federal funds rate. They will say, okay, we want the federal funds rate to be within this rate and this rate. It's usually about a 1/4 percentage point. Then they use certain policy to implement that, and that's what we're going to talk about here this morning. Where do we go from there, though? If they increase the federal funds rate, then that causes other market interest rates to increase, right? If interest rates go up, we know that our spending decisions will change. Investment tends to go down, and also spending on things like consumer durables goes down. When those things go down, aggregate demand goes down, right? And in that case, aggregate demand would shift back to the left, and that might pull us back out of an inflationary gap. That's the kind of policy that the Fed has been undertaking for the last couple of years. If instead they announce a lower target for the federal funds rate, and they undertake the policy necessary to do that, that lower federal funds rate then causes market interest rates to fall. And then we know that when interest rates fall, investment spending increases, spending on consumer durables increases, aggregate demand increases, the aggregate demand curve shifts to the right. That might help pull us out of a recession. So that's that chain effect kind of thing that several of you were indicating that you were having trouble with. All right, so let's move on here. If I can get my slides to advance. All right, again, what they're doing is they're setting a target range. This just shows you the range. They usually do a really good job of hitting it right in there in that range. All right. So here we go. Here are those administered rates. So these on the left there, you'll see that what we call the implementation tools. 3 of them are the administered rates, and the 4th is open market operations. Again, open market operations used to be the primary tool. Now they just use it to make sure we remain in what they call the ample reserves regime, meaning there's still a lot of reserves in the banking system. That's all we're doing there. All right. So again, what's going on here is that we used to be in this portion of this demand curve. This is the money demand. Here's money supply. We used to be over here, right? So when we increase the money supply and we push the money supply to the right, that caused the rates to fall, right? But since 2008, we've been out here. So you can start to understand why changing the money supply isn't really doing anything. So that's the situation we're in. So now they use these rates in a different way. Okay, so we've identified the discount rate. That is the rate that the Fed charges banks for these emergency loans on an overnight basis. So banks can go to other banks to borrow money. That's the federal funds rate. They can go to the Fed to borrow money. That's the discount rate. Now the thing about the discount rate is banks don't really want to do that. Because if they have to go to the Fed and borrow money, that may be an indication of weakness. That may be an indication to the Fed to say, we may need to go and audit their books. Things may not be going great, right? So the discount rate is like a last resort for banks. And in fact, we refer to the Fed as the lender of last resort. So they're going to go to the federal funds market if they can. They're only going to go and borrow at the discount rate as a last resort. So again, that's how the discount rate kind of serves as a ceiling there. So again, let's talk about these rates. The interest on reserve balances, and again, this is why we kind of mark that changeover point from the old way of doing things to the new way of doing things is 2008. Because 2008 is when the rules were changed and the Fed began paying interest on reserve balances. Prior to 2008, they didn't pay anything. So now banks that have money sitting in their account at the Fed get interest on that money, just like you or I get interest on our savings account. Okay, so that is for banks that have accounts with the Fed, commercial banks that have that offer checkable deposits, checking accounts. Okay. So again, what's going on here is the Fed is using a couple of concepts. The first is the reservation rate. So what we're getting at here, we're going to get to this in a couple of slides, is the idea of arbitrage. So if you're familiar with arbitrage, hang on. So the first is the reservation rate. This is the lowest rate that banks are likely willing to accept for lending out their funds. So remember that banks are in this to make money. Okay? If they're making loans to other banks, it's not because they're trying to be friends. They're doing that because that earns them some interest. So for banks, they're going to have a bottom line, right? They're always looking for the best deal, and they're going to have a lowest rate that they're going to be willing to lend out to make it worth their while, okay? So again, thinking about the ways that banks can earn money. They can put their money in their account the Federal Reserve, and when they do that, they earn that interest on reserve balances rate. So that's one way for them to earn money. The second way is they can lend out that money in the federal funds market, and when they do that, they earn the federal funds rate. The third way is they can buy treasury bills and bonds, and when they do that, they earn the interest rate on those, right? So basically what's happening is these banks are constantly looking at these three options and trying to decide where can we make the most money, right? Because they're operating from this profit incentive. So the interest on reserve balances is nice because it's risk-free, right? To banks, it's risk-free. They know they can stick their money in the Fed, it's going to be safe, and they're going to earn that amount of interest, right? So as long as that interest on reserve balances rate is higher than those other market rates, they're going to stick their money in the Fed all day long, right? Because it's safe. So that's one of the reasons that the Fed has now started using this interest on reserve balances rate, because they know that they can use that relative to the other rates to kind of steer banks' behavior. Okay, so we said we've got the reservation rate and here's arbitrage. Okay, so arbitrage is basically when you're taking advantage of a situation. Okay, so the definition here on the slide is the simultaneous purchase and sale of funds or goods in order to profit from a difference in price. Buy low, sell high, right? That's kind of what we're talking about. So ultimately what the Fed is doing is they know that banks have these choices, right? They can put their money in their account, the Fed, they can loan it out in the federal funds rate, or they can buy bonds, right? So they have figured out that if they set that interest on reserve balances rate, which is the rate that they do set. Remember, the federal funds rate they don't set. But they figured out that if they set the interest on reserve balances rate higher than the federal funds rate, banks are going to want to try and game the system. Okay, so what they're going to try and do is they'll say, okay, we can borrow in the federal funds market. We will borrow money at this lower rate. We can deposit at the Fed at this higher rate, and we pocket the difference, right? That's arbitrage. So let's look at an example here. Okay, so let's say that the current interest on reserve balances rate is 2.5%. The federal funds rate is 2%, right? So the bank's got to decide, what do we want to do? How can we earn money? We can either make a loan in the federal funds market that earns us 2%, or we can stick it in our account, the Fed, that earns us 2.5%. Now we might say, okay, that's easy. They're just going to stick their money in the Fed and earn 2.5%. But banks take it even further. What they figured out they can do is, again, they borrow in the federal funds market, and when they borrow, they pay 2%. So they borrow this money, they're paying 2% to borrow it, but then they stick that same money in the Fed where they're earning 2.5%. So they're earning 0.5% more than they're spending, and that becomes their profit. You'll notice on the slide it says 50 basis points. This is the way the banking system, that's the language they use. Instead of saying 0.5 percentage point, they'll say 50 basis points. And you may be thinking to yourself, well, 0.5 percentage point isn't a lot, right? But y'all, we're talking about millions of dollars here, okay? So it adds up, all right? So this is what we mean by arbitrage. They're taking advantage of the system, and the Fed knows they will do this, okay? So what happens when they do this is banks want to borrow more and more money in the federal funds market so they can put it in their Fed account and earn that higher interest rate. That increases the demand in the federal funds market. And when demand increases and supply doesn't change, what happens to price? Price gets pushed up. Well, in the federal funds market, the price is the federal funds rate. So what happens is this little process of arbitrage will continue until the federal funds rate gets pushed up to even with the interest on reserve balances rate, right? This is what the Fed is doing. They're counting on banks to do this, right? So this process will continue until the federal funds rate gets up to equal to the interest on reserve balances rate, and then that incentive to borrow in the federal funds market and park it in the Fed goes away, and we return to kind of an equilibrium state, all right? Now let's look at the opposite. Let's say that the federal funds rate is 3%, but the Fed's only paying 2.5%. What are banks going to do now? Okay, they're going to take their money out of the Fed and they're going to start making loans in the federal funds market, right? Because they're giving up 2.5% in interest, but they're gaining 3%. So they're still going to profit that half percentage point or those 50 basis points. But again, the catch is that as they do that, they're increasing the supply in the federal funds market. And if supply increases and demand doesn't change, the equilibrium price falls. And in the federal funds market, that equilibrium price is the federal funds rate. So again, this activity will continue until that federal funds rate gets pushed down to where it's even with the interest on reserve balances rate. And then we kind of get to a point where there's no incentive to do anything different anymore. Okay? So that is how the Fed is targeting, or I like to say they're pushing the federal funds rate around, right? They're not setting it, but they're using this arbitrage process to influence either the demand for funds in the federal funds market or the supply of funds in the federal funds market to influence or push around that federal funds rate. Okay? So the bottom line here is if they want to raise the federal funds rate, they raise the interest on reserve balances rate. And that sets that whole arbitrage process in motion. If they want to lower the federal funds rate, they lower the interest on reserve balances rate, which again sets that whole process in motion. All right? Okay. So that was the interest on reserve balances. A lot of you struggled with the overnight reverse repo rate tool. And I'm going to go through this, but I want to say at the very beginning what the main thing that I want you to understand about this administered rate is that it's basically doing the same thing as the interest on reserve balances rate. What we have is a situation where we have banks, commercial banks, that offer checking accounts that have accounts at the Fed. So they get that interest on reserve balances rate, and they're part of that process. But there are other financial institutions, and throughout history, the financial services industry has grown and changed a lot. It's changed a lot since the Fed was created, and we have a lot of different types of financial institutions now that do have a lot of influence on the economy. However, they do not offer checking accounts, so they do not have accounts at the Fed. So if they do not have an account at the Fed, they don't get this interest on reserve balances, so that rate does not affect them. And so again, part of this shift from, pre-2008 to post-2008 was the Fed realizing, we have these other financial institutions out there that are really a large part of this process, but we're not able to affect them with the interest on reserve balances rate. So what they do is they use this overnight reverse repurchase tool to do the same thing. Okay? So again, the Fed's only legally allowed to pay interest to the commercial banks, the ones that have accounts. But these other financial institutions are a big part of the process. So they're using this overnight reverse repo rate to do the same thing. And yes, if you read the textbook carefully, you read it, it's technically a sale and a buyback. And this is overnight, right? All these things we're talking about overnight rates, very, very short term. So yes, technically it's a sale and a buyback. But the way they look at it is the difference between the sale and the buyback price is equivalent to an interest rate. Okay? So again, what they're doing is they're incentivizing these other financial institutions to earn money this way instead of in what we call the money market. Okay, so that would be not the federal funds rate per se, but other interest rates. So this is a way that they're influencing other interest rates. Okay, but again, to me, the most important thing that you understand is that it's doing the same thing as the interest on reserve balances rate. The interest on reserve balances, incentivizes banks. If they raise it, then banks say, hey, this is a better alternative than lending in the federal funds rate. For the other financial institutions, if they raise this overnight reverse repo rate, I always get that backwards. If they raise that rate, they're giving those other financial institutions a better option than other lending and other money markets. Okay, so they're using it in the same way, and that's the most important thing for you to understand. So again, they'll set those rates and they kind of move them in lockstep. They're about the IORB rate is usually about a tenth of a percentage point higher than the other, and that just allows the Fed to manage to keep banks and what we call non-banks separate, and have that little gap to help them manage things. Okay, so if either one of those, if those go up and they move together, then we tend to see the federal funds rate rise. If they go down, we tend to see the federal funds rate fall. That's the basic mechanism here. And again, the discount rate just sits up there at that ceiling because banks are going to use that as a last resort. So it just kind of sits out there and provides that highest point that none of those rates will ever go above. That's the point it serves. That's the point the discount rate serves. Okay. So again, open market operations in this new regime or post 2008 are simply used to make sure we stay out here, right? If the money supply ever comes back in here somewhere, then the Fed is going to say, let's buy some bonds and push it back out. So that's all open market operations are used for anymore. Okay, so again, here's the mechanism. The Fed is going to lower the target for the federal funds rate, and they're very obvious about this. They tell the world what they're doing, okay? They lower the interest on reserve balances rate. They lower that overnight reverse repo rate, right? As they do that, that arbitrage starts to happen, and this entire window moves down, and the federal funds rate moves down with it. The opposite effect is if they want to increase the federal funds rate. Again, the first thing they do is they tell the world, then they raise these other rates, and the federal funds rate kind of moves in lockstep with them. All right. So then again, the idea of putting things all together here, we kind of have to think about where we're starting. If we're starting at a point where it looks like the economy is starting to weaken, employment is falling below maximum employment, otherwise unemployment is increasing, right? The inflation rate is steady or slightly below 2%, but is showing signs of decreasing. These are both signs of a weakening economy. So what is the Fed going to do? They want to prop the economy up. And remember, the monetary policy, just like fiscal policy, is all about affecting aggregate demand. Okay? So the Fed is going to want to increase aggregate demand. So how can they do that? By lowering interest rates. Okay? So again, they're going to announce to the world we're lowering our federal funds rate target rate. They're going to lower those administered rates. The federal funds rate is going to shift down into the lower target range. Other market rates decrease. When interest rates go down, investment spending goes up. Spending on consumer durables goes up. Aggregate demand goes up. And real GDP goes up. And unemployment goes down. See how that works? If instead, this should sound familiar, inflation has been above the Fed's 2% target for a considerable time and inflation is increasing, the unemployment rate is very low. This is the situation we found ourselves in a couple of years ago. So what did the Fed do? They announced to the world they were increasing the federal funds rate target range. They raised those administered rates, and they did it in steps, right? Every couple of months, they'd raise them a little bit more. The federal funds rate increased with them. Other market rates increased. As interest rates increased, investment spending decreased, consumer spending decreased. Now, what we saw with this latest round of inflation was that we think that a lot of folks had a lot of savings socked away because of COVID, right? We had a time period where the government was giving us COVID money and a lot of our expenses decreased because we couldn't go anywhere. So even as interest rates were going up, we kept spending. So it took them a while, right? They had to push interest rates up quite a bit, but finally some of that inflationary pressure backed off. And we've seen the inflation rate start to fall. Now remember, the inflation rate is just the rate of change. We do not expect prices to actually come down that much. But we've seen that. We've seen inflation fall from about 9% to the last one, I think, was about 3.5%. So there's still work to be done. The Fed is now kind of sitting on their hands and saying, well, we don't know if we're going to be able to start lowering interest rates anytime soon. But this is the exact process that we've been through in this country in the last couple of months. Years, excuse me, months. All right. So I'm actually going to pull this slide out of this presentation and I'm going to post it in Canvas because I think it's a good reference point for you, especially for those of you who are struggling to keep these things straight. But again, this gives you those tools, a little bit of a description, and how they're used in practice. All right. So again, if you are still struggling with this, the main points that I want you to understand. First of all, the Fed targets the federal funds rate. They do not set it. They use monetary policy to influence it. Expansionary monetary policy is going to be something that causes aggregate demand to expand. So what's going to do that? We need investment spending to increase. We need consumption spending to increase. So we need interest rates to fall. So expansionary monetary policy involves pushing down interest rates. Contractionary or restrictionary policy is that causes aggregate demand to contract, right? Or decrease. So what's going to cause that? Higher interest rates. So contractionary or restrictive monetary policy is going to involve increasing interest rates. That is the bottom line. And if you can't get any of the rest of straight, that's the most important thing. Okay? And so then I know some of you had expressed some confusion with that, putting it all together at the very end of the chapter. Again, all that was showing you was how all these different pieces fit together, right? The fact that now we've built this aggregate demand, aggregate supply model, that then we can start to see how these pieces relate to our level of real GDP, how they relate to the inflation rate, how they relate to unemployment. And we're also able to see how fiscal policy and monetary policy affect aggregate demand. So you got all that we've talked about in terms of taxes, spending, interest rates. That's all on the aggregate demand side. So that's all that was about, was kind of giving you a visual for how all those different pieces fit together. If you're still struggling with that and continue to struggle with that, please let me know, and I will try to see what I can do to help you there. But this was by far the biggest point of confusion that I saw from this week's reflection, and so I definitely wanted to spend some time with this. If you still have questions about this, please email me, and we'll see what we can do. But again, the high-level stuff is what's the most important for me, and particularly the information about the overnight reverse repurchase rate. If you can understand nothing more than it works like the interest on reserve balances for non-Fed institutions, that's great. All right, hopefully this helps. Y'all keep working. You're almost done. And let me know if you have any questions.